I was at a backyard barbecue last weekend, and I got cornered by a neighbor. You know the type. Prides himself on being fiscally responsible.
Oh, I think I know where this is going.
He was practically vibrating with anxiety, scrolling through this website on his phone to track the U.S. national debt in real time. He shoves the screen in my face, and we're watching the numbers tick up past $38 trillion.
Whoa.
His expression was just this mix of horror and, righteous indignation. He kept saying, "It's over. We're spending money we don't have. China's going to come collect, and we'll be speaking Mandarin by Tuesday."
A classic line.
To him, the logic was just ironclad. A country is like a household, and the credit card is totally maxed out.
Ha.
But then the conversation pivots to his retirement plan.
And this is where it gets interesting.
This is where things got really strange. The moment he starts talking about his portfolio, his entire demeanor just softens. He's beaming, bragging about how he'd moved his savings into the safest assets on earth.
Let me guess. U.S. Treasury bonds.
U.S. Treasury bonds. He was talking about the guaranteed interest, the security of the American dollar, with total, unwavering confidence.
The contradiction is just staggering.
It left me stunned. In one breath, he's terrified that government debt is a ticking time bomb. In the very next, he reveals he's the one buying that bomb. He's banking his entire future on the belief that the government will never actually pay it off, but just keep paying him the interest. He didn't see it.
He was both the victim and the creditor in his own story.
Exactly. He thought he was the victim of the debt, but he was actually the creditor. And it forces you to look past all the panic and ask the question that nobody at that barbecue could answer. If every country on earth is drowning in red ink, who exactly is standing on the other side of the ledger? And that really is the mission of this deep dive. We're going to look past the panic, past the fear-mongering headlines, and try to understand the real architecture of modern sovereign debt. We're going to explore who holds the world's IOUs and how this massive circular system actually functions.
Or, more importantly, why it's explicitly designed not to fail in the way a household might.
Right. That's a crucial distinction.
It really is. We need to draw a line right away between, personal finance and public finance. When we talk about sovereign debt, what we're really defining is a government's financial liability to its creditors.
And they don't just take on this debt for fun.
Not at all. It's a powerful policy tool. They use it to fund essential public services, make these huge capital investments, and just improve welfare when tax revenues.
Right.
Well, when they fall short, it's an economic lubricant. Really.
But it can get corrosive.
It becomes very corrosive when it's mismanaged. When that spending doesn't generate future productive value, that's when you get problems that affect people for generations. It has huge economic, political, and social ramifications.
And the scale is just hard to get your head around. It's not just the $38 trillion in the U.S. Yeah. By the end of 2023, global sovereign debt, all governments combined, hit $98 trillion.
Which is about 94% of the entire global gross domestic product.
But even that's not the full picture. If you add in corporate debt and household debt mortgages, credit cards, all that stuff, the total global debt figure is over $315 trillion.
That's nearly 3 times the size of the entire global economy.
This isn't just some number on a balance sheet. This is the invisible scaffolding that the modern world is built on. It's like the air we breathe in global finance.
To really understand this architecture, you have to go back to its origin story, because the past really explains why the present system is structured the way it is. It wasn't born on Wall Street.
No, it was born from conflict.
Exactly, from the crucible of war, specifically in 17th century Europe.
Okay, so let's set the scene. It's 1694, England. The English crown is fighting a really expensive war against France.
And they're running out of hard money. They're running out of gold and silver to fund the war effort. So the king turns to these private merchants, the banking class in London, with a pretty radical deal.
Which was?
Finance the crown, and in return, you'll get a permanent stream of interest payments. And those payments would be backed by future tax revenue.
That was the revolutionary moment, wasn't it?
Absolutely. Instead of just seizing wealth or relying on taxes, the crown created a perpetual revenue stream for itself just by selling promises. They chartered the Bank of England to manage this whole new arrangement.
And for the first time, the state could spend money it just didn't have.
All based on a promise of future solvency. And for the lenders, they got something even more valuable than just getting their money back. They got a government promise, a bond that wasn't just paper. It was an asset they could buy, sell, and trade.
And that was the birth of the modern government bond, the seed of our entire financial system.
It was, and this idea, the state-backed IOU, it spread like wildfire because it was just so effective. France copied it, the Netherlands refined it.
And the newly independent United States used it to fund its revolution.
Extensively. And here's the ultimate irony of national debt. It quickly stopped being seen as a sign of failure. It became a measure of a nation's credibility and its power.
So the ability to borrow huge sums of money meant you were a major player.
It became synonymous with the ability to rule. Empires stopped focusing just on conquering land for gold and started focusing on maintaining the confidence they needed to issue bonds and collect interest. The balance sheet became the new battlefield.
Which brings us right back to today. That $315 trillion figure means basically every country, every major bank, and through our pensions and savings, every one of us is both a debtor and a creditor at the same time.
Which forces that core question, who is holding the other end of the rope, especially in the biggest market, the United States?
Right. You can't talk about global debt without starting with the American example. That $38 trillion number my neighbor was so scared of. When you start looking for the creditor, the picture gets complicated fast.
It does. We need to look at the part that's publicly held, the part owed to investors, not other government agencies. And when you do that, you find that roughly 2/3 of those creditors are domestic.
They're American.
They're American. We're talking commercial banks, massive retirement funds, mutual funds, insurance companies, and the single biggest holder of all, the Federal Reserve itself. This internal holding is absolutely critical for stability.
And here's where the public narrative just completely diverges from reality. It's that remaining 1/3, about $9 trillion, that's held by foreign entities. And the headlines always focus on one country.
China.
China. The perceived geopolitical risk of China holding U.S. debt. But the numbers, they tell a very different story.
They really do. As of the latest data, Japan is actually the top foreign holder. They have about $1.1 trillion of U.S. debt.
$1 trillion.
China is usually the second largest, typically somewhere around $800 billion. That number fluctuates, of course. And then you have the UK, Luxembourg, Belgium. They all hold significant amounts.
But the narrative is always China. Why is Japan so reliant on holding U.S. debt? What's in it for them?
Well, Japan, like a lot of big export economies, builds up these massive foreign exchange reserves from trade surpluses. They have to put that money somewhere safe and liquid.
And U.S. treasuries are the gold standard for that.
Exactly. They are the gold standard for safety and liquidity. So by holding treasuries, Japan stabilizes its own currency, which keeps its exports competitive, and it also ensures the smooth flow of global trade, which its own economy depends on. It's a mutually reinforcing relationship.
So let's go back to my neighbor's fear. When people worry about the U.S. being indebted to China, the real takeaway here is that the debt owed to China is only about 2% of the total U.S. national debt.
Roughly 2%, but that's not to say that 2% is meaningless.
Okay, that's a critical distinction. But doesn't that $800 billion still give them huge geopolitical leverage? I mean, what if China decided to just sell it all at once?
Yeah.
How is that risk managed?
That's the core of the market confidence issue. Theoretically, yes, China could liquidate its holdings very quickly. It would cause a sharp temporary spike in U.S. interest rates, a lot of market panic. But doing so would instantly crash the value of the remaining $800 billion they still hold. It would be an act of massive financial self-harm. They'd be weaponizing their own portfolio against themselves.
And that's not in their interest.
Not at all. Especially since China's goal is economic stability and growth. So it's kind of a financial version of mutually assured destruction. The ties are so deep that it forces both sides to maintain stability.
So it's a circular mirror. The U.S. Treasury issues bonds, American institutions buy them, the Fed buys them back, creating new dollars. Then Americans pay taxes to service the interest on those bonds, and that interest flows right back into American retirement accounts.
The debt is very real, but the creditor is largely a reflection of the same system, cycling money back to its own savers.
And this circular system is replicated across the whole planet. It's like a planetary game of hot potato.
That's a great way to put it. The world is interwoven in this closed loop of promises. Japan lends to the U.S. The U.S. lends to Europe through the IMF. Europe lends to developing nations through the World Bank.
And then developing nations lend back to the West by parking their reserves in.
In Western bonds, especially U.S. treasuries, because they're seen as the most stable asset on Earth.
It's a closed loop of poker chips, all secured by the next person's promise. And the only rule that keeps the game going is that nobody stands up and questions the value of the chips. The only rule is perpetual confidence.
Exactly. When you look past the $38 trillion number, you see the real power isn't the debt itself, it's the debt market. It's the hedge funds, the pension funds, the central banks. They're the true arbiters of credit. They decide who gets to borrow cheaply and who doesn't survive.
Okay, so if everyone is lending to everyone, what happens when someone wants their chips back? This brings us to the core policy that separates government debt from your neighbor's maxed-out credit card.
Yes. And this is probably the most important and counterintuitive truth in this whole discussion.
Which is that the system can handle this mind-boggling scale of debt because it's not actually designed to be paid back.
Not in the traditional sense, no. When you or I take out a loan, we're expected to pay back the principal until the debt is zero. But governments operate under a completely different logic. Their plan is not to pay off their debt. Not now, not ever. And that's not a conspiracy theory.
It's just policy.
It is explicit, stated financial policy.
You've described this as a rolling subscription. Can you break that down? What is refinancing in this context?
Certainly. The core mechanism is refinancing. When an old government bond matures, let's say a 10-year treasury bill, the government doesn't just find the cash to pay off that principal amount.
Right.
Instead, it issues a new bond, often for the same value or even more, and it uses the cash from that new bond to pay off the old one. This continuous rolling over means the principal amount of the debt is effectively permanent.
The debt is perpetual.
Exactly. And so the interest becomes the real product. It's the rent charged for stability. That interest payment is the government's commitment to its creditors, and it's what keeps the bond desirable.
So this means the global economy actually depends on governments not paying off their debt. Why would eliminating debt be a bad idea?
Because a U.S. Treasury bond or a high-rated bond from Japan or Germany isn't seen by the market as a liability you need to get rid of. It's seen as the safest collateral in existence. It's the foundational asset of the entire system.
So pension funds, banks, central banks, they treat this debt as money itself.
Or as the perfect asset to back up loans, to hold as reserves, and to facilitate just countless daily financial transactions.
Okay, so let's play this out. What if the U.S. government somehow decided to eliminate its debt overnight? What would that chain reaction look like?
It would be catastrophic, utterly catastrophic. Banks and financial funds all over the world would suddenly lose their most stable, liquid, and universally accepted asset. The supply of safe, tradable assets would just vanish.
And all the transactions that rely on treasuries as collateral would just seize up.
They'd seize up. This sudden asset shortage would trigger massive deflation, a sustained drop in prices, and a global economic collapse far worse than anything we've seen in decades. So, in essence, paying off the debt would destroy the very financial instrument that makes modern capitalism work.
So they do the opposite. They keep issuing more to maintain the supply of this safe asset.
That's the goal. It's not elimination, it's sustainability and credibility. The debt has to be manageable, the interest has to be serviceable, and the bond has to be desirable enough that investors just keep renewing the deal.
We can see this in action with a couple of case studies. Let's start with Japan. They have a debt load that looks terrifying on paper.
It does. Japan has the world's highest public debt to GDP ratio. It's forecast to hit 242% in 2025.
2.5 times their entire annual economic output.
And that number surged because of massive government stimulus after their asset price bubble collapsed in the 90s, plus, huge spending to manage a rapidly aging population.
Yet we don't hear about Japan in the same way we heard about Greece or Argentina. Why is their system so resilient?
The resilience is structural. First, that debt is overwhelmingly held domestically. About 90% of Japanese government bonds are held by Japanese investors and institutions.
Including the Bank of Japan itself.
Including the Bank of Japan, which has been buying up a huge amount of that debt, which keeps borrowing costs incredibly low. The government is essentially borrowing from itself and from its own savers, who see these bonds as the ultimate safe haven.
And those investors aren't demanding repayment, they're just renewing the deal, treating the bonds as stable assets for their retirement.
Just like your neighbor, it's a structurally self-reliant system.
Now contrast that with Singapore. Their debt to GDP ratio is also really high, forecast around 173%, but their situation is completely different.
Completely different. Singapore consistently runs budget surpluses. They have massive foreign reserves. They don't issue debt to cover deficits.
So why issue it at all?
It's strategic. They do it for two main reasons. First, to develop their financial markets by providing a high-quality benchmark asset. And second, to support their mandatory savings scheme, the Central Provident Fund. It's debt used as a prudent financial tool, not a sign of fiscal strain.
And the U.S. manages its own debt because of the dollar's special status.
The dollar being the global reserve currency, that creates a perpetual global demand for U.S. Treasury bills that keeps borrowing costs down and ensures the system keeps rolling over, almost regardless of the total debt number.
But the whole thing is built on confidence. And when that confidence breaks, the creditor-debtor relationship gets very real and very painful.
That's when those interest payments suddenly feel like a genuine burden. We saw it dramatically in the Greek crisis around 2010.
Their debt became unpayable. Bondholders panicked, and their borrowing costs skyrocketed. Refinancing became impossible.
And suddenly, the creditors, the ECB, the IMF, their Eurozone partners, they became very visible, and they demanded massive political sacrifices.
Austerity, tax hikes, spending cuts, pension cuts. An entire generation sacrificed to appease the creditors.
And you see similar stories in Argentina with its repeated defaults, or Sri Lanka, which literally ran out of foreign currency to service its loans, leading to immediate economic paralysis. In those moments, the anonymous creditors suddenly have a face, and they're holding nations by the throat.
But even after a collapse like that, the debt is never truly eliminated. It's restructured. New loans replace old ones. The machine just resets.
Precisely. The system has to keep turning because the global economy depends on that perpetual motion. The fundamental function of sovereign debt is to never stop issuing the asset that the global financial system needs to stabilize itself.
Let's shift our focus now to one of the most significant and I think often misunderstood players in this whole network, China.
China's role is really dual-pronged. First, it's a massive buyer and a stabilizing force in the bond markets of advanced economies, as we've discussed. But second, and this is maybe more crucial for global development, it's now the world's largest bilateral lender to low- and middle-income countries.
These are developing nations that really depend on external financing for growth.
They do. The World Bank estimates that these countries owed about $181 billion to China at the end of 2022. That makes China's policy decisions incredibly important for preventing debt distress in many vulnerable nations.
And we have to talk about the debt trap narrative here.
Yeah.
It's dominated Western media coverage, especially around the Belt and Road Initiative, the BRI.
It has. The narrative suggests China is using lending as a geopolitical tool to seize assets, almost like a financial Trojan horse.
But what does the evidence say?
Well, it's essential to look at this objectively, and a growing body of research is showing that this narrative of debt trap diplomacy is, well, it's largely a myth that's spread out of a kind of negativity bias and geopolitical competition.
So what was the real intention behind the BRI?
The primary drivers were fundamentally economic. China had these massive overcapacities after decades of intense domestic industrialization. They had surpluses of goods, services, construction capital. All of it was yielding diminishing returns at home.
So the BRI was a way to externalize domestic problems, as it was put.
Exactly. They were stimulating external demand by funding infrastructure projects abroad that required Chinese steel, Chinese engineers, and Chinese financing. It was a strategic move to ensure their own continued economic stability.
And the stability China provides goes beyond just that direct lending. We can see this in the story of Chen, a logistics coordinator in Shanghai. He saw this firsthand.
He did. Chen observed how China's huge holdings of U.S. and European treasuries acted as a crucial stabilizer during periods of intense global volatility.
He specifically mentioned the 2020 global market tremors. While there was panic everywhere else, he saw China's steady holdings acting like a giant invisible gyroscope.
And this wasn't just abstract finance for him. It had very real, tangible outcomes. He was tracking a shipment of critical medical supplies heading to a partner nation in Central Asia.
And that shipment was financed through credit lines that only existed because the underlying sovereign bond market was still liquid.
A market stabilized by China's prudent management and steady holdings of those core assets. If those markets had seized up, which they were threatening to do, that whole supply chain would have just stopped.
So China's role provided the necessary ballast, the financial heartbeat, that allowed global supply chains to function. It shows that debt isn't just a hole on a balance sheet, it's the pavement on the global trade road.
Given this massive role, China's policy decisions on debt relief and restructuring are paramount for global debt governance. You have countries like Laos PDR, Djibouti, Zimbabwe, they owe a huge share of their public debt to China.
55% for Laos, 51% for Djibouti.
Exactly. So China's getting more and more engaged in offering early-stage debt relief to prevent collapses, both for the partner nation's sake and to avoid losing its own financial claims.
And they're also pushing a climate-centered approach to this, right? Promoting green development under the PRI.
They are. It's a considered long-term approach that tries to hit two goals at once: mitigate immediate debt distress while also addressing long-term vulnerabilities to climate change. They're trying to build genuine, sustainable capacity.
And this is particularly interesting when you look at the history of Western creditors.
Right. Before China's rise, Western creditors often ended up in a situation where they just had to cancel massive amounts of debt for the world's poorest nations through things like the HIPC initiative.
HIPC and MDRI.
The Heavily Indebted Poor Country Initiative. The relief was essential, but the financial loss was just absorbed by the lenders. China is trying to navigate being a huge creditor without repeating that same history, while still addressing that fundamental challenge. How do you finance transformative development without creating crushing debt burdens?
So let's move from that global stability role to a more regional, dynamic one. How are developing nations actually using debt, not as a crisis, but as an engine for growth?
This perspective is captured brilliantly in the story of a man named Budi, a civil engineer from Jakarta.
Budi grew up dealing with Jakarta's infamous, soul-crushing traffic gridlock. And for decades, the narrative around national borrowing in Indonesia was one of fear.
The idea that taking on debt would sell out their future to international institutions.
Exactly. But then Budi started working on the MRT Jakarta project, a huge, complex infrastructure project funded largely by strategic national debt and international bonds.
And this was very personal for him. He took his father, who had lived through the '97 Asian financial crisis, and saw debt as poison for a ride on the new Ratanga train.
And as they're gliding through the tunnels, bypassing all the chaos on the streets above, Budi reframes the debt for his father. He says the bond wasn't a bill for his grandchildren. It was the engine that would allow his grandchildren to work and thrive.
That's a powerful moment.
It was. The realization that the debt had been literally transformed into concrete, steel, and speed.
That story really humanizes a crucial economic reality. For nations like Indonesia, Malaysia, and Vietnam, debt is a dynamic, essential catalyst. It bridges the gap between a stagnant present and a functional, productive future.
This is the difference between debt for consumption versus debt for capital formation.
Exactly. One can be crippling, the other generates future revenue.
And this Asian model is pretty different from the Western approach, specifically the public-private partnership, or PPP, model.
Very different. The Asian model, which was heavily influenced by China, relies on the dominance of state-owned enterprises, or SOEs, for financing, construction, and operation.
And these SOEs were a direct answer to a huge problem in Southeast Asia, which was these crippling infrastructure gaps.
A massive problem. Data from 2012 to 2018 showed Indonesia and Vietnam ranking way down, like 61st and 54th, in infrastructure quality. The private sector PPP model just wasn't solving the problem fast enough. These projects are too big, too risky, and not profitable enough for private capital alone.
So the government has stepped in, not just as a regulator, but as the main builder, using these SOEs. Can you explain the strategy behind that, the grasp the large, let go of the small idea?
Absolutely. It was a deliberate reform strategy. Let go of the small meant getting rid of smaller, inefficient SOEs through mergers or liquidation. Grasp the large meant letting the remaining, biggest, most strategic SOEs dominate these crucial infrastructure projects.
Like PT Wijaya Karya in Indonesia, building the Jakarta-Bandung high-speed railway.
Exactly. And the key consequence of this model is the corporatization of debt. These SOEs take on massive corporate debt to fulfill their policy mandates, and it's a deliberate tactic that conveniently moves the debt off the central government's direct public balance sheet.
That seems like a clever bit of accounting, but it has to create risks, doesn't it?
Yeah.
If these huge state-backed SOEs take on all this debt, isn't that just creating a massive contingent liability for the government?
That is the critical trade-off. You hit the nail on the head, a contingent liability. These SOEs get cheap loans from state-owned banks, they get subsidies, and most importantly, they get the implicit promise of a bailout if they run into trouble.
So the market knows the state will never let them fail.
The market knows. This creates significant moral hazard where the SOE knows it can take on riskier projects because the government, its owner and regulator, will be the ultimate backstop. The debt is hidden from the public balance sheet, but the underlying risk is still there.
So it's a structural choice. They accept that risk because the benefit of getting that infrastructure built, the concrete steel and speed, outweighs the fiscal risk of having that debt show up instantly on the books.
Precisely. It allows them to deploy capital with a speed and scale that pure private models just could never achieve.
And what's remarkable is how well it has worked. The data from 2018 to 2022 shows an incredibly positive utilization ratio.
Look at Indonesia. Over that period, their increase in GDP was $276.1 billion. That was greater than their increase in government debt, which was $206.5 billion.
A ratio of 1.34. For every dollar borrowed, they generated $1.34 in economic activity. That's a profitable use of capital.
It is. And then you look at Vietnam, their performance was just striking.
Even better.
An increase in GDP of $102 billion on an increase in government debt of only $18.2 billion. That's a ratio of 5.61. For every dollar they borrowed, they generated over $5.50 in economic activity, an exponential return.
And those numbers really stand out when you compare them to other major economies, the US, China, India, where debt increase was actually greater than GDP increase over that same period. It really validates Booty's sentiment. The debt was successfully transformed into a functioning revenue-generating economic engine.
And that drive for efficiency is now moving from the physical infrastructure to the financial infrastructure itself. The next major evolution is happening in the digital realm.
This is about making the entire process of issuing and trading debt faster, cheaper, and more transparent.
Which is perfectly illustrated by the story of Sarah, a bond trader in Singapore. The traditional process for settling a bond trade is notoriously slow. It's called T+2 settlement.
The transaction is agreed upon today, but the final transfer of cash and assets doesn't happen for 2 business days.
Exactly. It's clunky, it's inefficient, it creates risk. But Sarah was part of a pilot program testing tokenized sovereign debt, moving the government bonds onto a blockchain.
And she executed a cross-border trade with someone in Shenzhen, and the settlement was
instantaneous. She described it as upgrading the global financial system's nervous system. If traditional settlement is mailing a check, this is an instant wire transfer.
That's a great analogy.
Singapore and China aren't just borrowing money, they're increasing the velocity of that capital, making the whole web of global debt more efficient. And over 15 countries are now piloting these blockchain-based systems.
So let's break down the key innovations here.
Okay, first you have tokenized issuance. The digital bonds are recorded on a blockchain, so ownership is instantly verified. It improves transparency and accessibility.
Second, that instant settlement you mentioned. That dramatically cuts operational costs. The Bank for International Settlements estimates it could reduce post-trade reconciliation costs by up to 80%.
Which is a massive saving. Third, you have smart contracts. These are self-executing contracts where the terms are just written into code. They automate things like interest payments, which minimizes human error.
And finally, it opens up true retail access. Citizens can now invest directly in small denomination bonds using a mobile app, which expands the domestic creditor base.
And adoption is already happening. Singapore, India, the Philippines, they've all launched digital bond pilots.
And the future isn't just digital bonds, it's full interoperability, creating these smart debt ecosystems.
We're looking at some huge emerging trends. One is AI-based pricing models that can assess market conditions with incredible precision. Another is central bank digital currency, or CBDC integration.
Using a digital version of a country's fiat currency to make settlement even faster and cheaper.
Exactly. And finally, we're seeing more ESG-linked sovereign bonds that use blockchain to track sustainability performance on-chain. This directly ties countries' borrowing costs to its verifiable performance on environmental and social goals.
It's all pushing public finance towards being real-time and accountable.
It's like installing a digital pacemaker on the global economy, strengthening the stability of the whole debt network for decades to come.
So we started this deep dive with the panic of a neighbor, terrified by a $38 trillion debt figure. We defined sovereign debt, we traced its origins to 17th century warfare, and we found that the world isn't drowning in debt to some external villain. The world is, overwhelmingly, its own circular creditor.
We established that the whole architecture relies not on the promise of repayment, but on the perpetual rolling promise of interest. The goal is to maintain confidence because government bonds are the essential risk-free collateral for the entire $315 trillion global financial system.
And we saw the most successful use of this debt engine in Asian economies. We saw China acting as a global gyroscope, using its treasury holdings as ballast to keep supply chains stable. We saw Southeast Asian nations turning debt into concrete, steel, and speed. And then the tech lead from Singapore and China, making the whole mechanism instantaneous and transparent.
But while the system maintains stability, we have to come back to that paradox we started with. Those interest payments don't flow equally. They flow upward. Every time a taxpayer services the national debt, those funds flow to the institutions and investors who hold the bonds.
The pension funds, the banks, your neighbor's portfolio?
Exactly. It's a fundamental economic truth that global inequality and global indebtedness tend to rise together. The system rewards the creditor class and effectively penalizes the taxpayer and the worker who service the interest.
And that's the complex flow of the entire system. When you strip away the fear and the rhetoric, you're left with the definitive secret of sovereign debt.
The plan was never to pay it back. The plan is to ensure the global system never stops believing in the promise of the interest, because the moment that belief fades, the entire engine grinds to a halt. The modern financial system has successfully turned debt itself into money, blurring the line between debtor and creditor beyond recognition and creating an engine that simply must run perpetually.